Welcome to this webcast where we will introduce the new accounting standard IFRS 18, presentation and disclosure in financial statements. My name is George Seifritzberger, and this is my colleague Marina Mittermeier.
Hello.
We are part of the IFRS advisory team at TPA, and we are happy to welcome you. To make a start, Marina, could you please give us an introduction to IFRS 18 and explain to us how the new standard will improve financial reporting?
Yeah, sure. Let's have a look at the next slide. IFRS 18 emerged from the IASB project primary financial statements in response to the demands from investors for better information about companies' financial performance. IFRS 18 leads to improved transparency in financial statements, giving investors a better basis for analyzing and comparing companies' financial performance. IFRS 18 applies to all companies across all industries. So that our listeners can understand the implications of IFRS 18, George, could you please present the key points of IFRS 18?
IFRS 18 contains 3 key points. The new standard requires new defined categories and new defined subtotals. The statement of profit or loss is divided into the operating, investing, and financing categories. The 2 new defined subtotals are operating profit or loss and profit or loss before financing and income taxes. Furthermore, IFRS 18 requires disclosures of management-defined performance measures, also called MPMs, such as EBITDA, which is not defined in IFRS. The standard requires a reconciliation of MPMs to the next directly comparable IFRS subtotal. Finally, the new standard provides guidelines on the grouping of information, also called aggregation and disaggregation of information. The grouping of information is about the interaction of line items in the primary financial statements and disclosures in the notes. IFRS 18 becomes effective for annual reporting periods beginning on or after 1 January 2027, including interim periods. Retrospective application is required, meaning comparative information must be prepared in accordance with IFRS 18. Marina, could you now please provide us with more details on the first key point, the categories and subtotals?
Sure. Investors had challenges comparing financial performance because companies presented their income statements differently. IS1 only required the presentation of profit or loss for the period and did not include any subtotals. In response, the IASB required 2 new defined subtotals, operating profit and profit before financing and taxes. Furthermore, the statement of profit or loss is divided into 3 categories: the operating category, the investing category, and the financing category. To better understand these changes, let's look at the structure of a statement of a profit or loss. The operating category is followed by the subtotal operating profit. Operating profit provides an overview of a company's main business activities. The operating category includes items of income and expenses that are not classified in the other 2 categories. The investing category is followed by the subtotal profit before financing and income taxes. One important line item is in the investing category is the share of profit of associates and joint ventures. The presentation of this item was previously not regulated. Profit before financing and taxes provides a picture of a company's financial performance before the effects of financing activities. The financing category contains interest expenses from bank loans, lease liabilities, or pension obligations. The guidance on presentation applies foremost to general companies. George, can you please tell us how certain companies with a specified business activity present their statements of profit or loss?
For some companies, the main business activity is financing or investing. Banks or insurance companies present income and expenses that general companies would present in the investing or financing categories in the operating category. For example, a bank's statement of profit or loss starts with interest income, followed by interest expenses, and concludes with net interest income. This subtotal is comparable to gross profit used in the income statement. Now, let's take a look at the second key point of IFRS 18, the management-defined performance measures. Marina.
Yeah, let's have a look at the management-defined performance measures, or MBMs. Are subtotals of income expenses that are not defined in IFRS, such as EBITDA or EBIT. Investors have said such measures can provide useful information, but they had concerns about the lack of transparency of how these measures were calculated. When using MBMs, IFRS 18 requires a reconciliation to the most directly comparable IFRS subtotal. Additionally, explanations must be provided on why an MBM is reported, how it is calculated, and if there have been any changes to the MBMs. George, could you please elaborate on the reconciliation of the MBMs?
Sure. Before we look at an example, though, of a reconciliation, let's consider another optional IFRS subtotal called operating profit before depreciation, amortization, and impairments, which may be abbreviated with OPDI. The IASB considered including EBITDA in the list of IFRS subtotals. However, after identifying up to 10 different calculations of EBITDA, the IASB opted not to include EBITDA in IFRS subtotals. Instead, OPDI was created. A company can optionally include OPDI in the structure of the statement of profit or loss, but it is not required to do so. If the company chooses to present any form of EBITDA in the statement of profit or loss, it must then reconcile EBITDA to OPDI after that to operating profit. In the first step of the reconciliation, the effects on taxes and non-controlling interest must be disclosed for each line. In the second step, the reconciliation to operating profit is made without details on taxes and non-controlling interest. Otherwise, if OPDI is presented as a subtotal in the statement of profit or loss, the reconciliation ends there. And now, Marina, let's take a look at the third key point of IFRS 18, the grouping of information.
Investors had concerns that some companies don't provide enough detailed information or that important information is obscured. IFRS 18 addresses these concerns by introducing rules for the grouping of information, also called aggregation and disaggregation of information. IFRS 18 provides guidance on the presentation of information in the primary financial statements and in the notes. An important aspect of the grouping of information is the formation or description of line items. The formation of line items is based on shared characteristics. The disaggregation of line items is based on additional characteristics, which leads to disclosures in the notes. Items labeled as other must be explained. Now, we have presented the 3 key points of IFRS 18. However, there are a few additional points, George.
Yes, Marina. Amendments have been made to IAS 7 statements of cash flows. Previously, the starting point for presenting operating cash flows was not regulated, which led to diversity in practice. Now, the calculation of operating cash flows must start with operating profit. In addition to the 3 key points mentioned before, IFRS 18 contains a few more changes. The standard provides guidance on the classification of cash and cash equivalents, derivatives, hybrid instruments, foreign exchange differences, as well as minor changes in the presentation of the statement of financial position. IFRS 18 replaces IAS 1 presentation of financial statements. Although large parts of IAS 1 have been incorporated in IFRS 18, including sections concerning the statement of financial position, other comprehensive income, or the statement of changes in equity. Marina, let's come to our conclusions on IFRS 18.
The new IFRS defined subtotals increase the comparability of financial statements. The presentation of the share of profit of equity accounted investees in the investing category ensures a consistent and comparable presentation. The reconciliation to the most directly comparable IFRS subtotal leads to a better understanding of management-defined performance measures.
The guidance on the grouping of information has changed. This will require companies to reconsider their chart of accounts and evaluate whether improvements can be made to the way in which line items are grouped and described in the primary financial statements. The level of operational change required by the new standard should not be underestimated, and companies should start thinking about the operational challenges as soon as possible. We, the IFRS advisory team at TBA, will be happy to assist you with the implementation of IFRS 18.
Dear viewers, we have reached the end of our presentation. If you enjoyed this webcast, please follow us on our channel. If you have any questions about IFRS 18 or other IFRS topics, please feel free to contact us. Thank you for your attention, and goodbye.